Welcome back to another episode of Multifamily AP 360. And today's our guest is Kevin Bupp from Sunrise Capital Investor. So welcome, Kevin.
Rama, thanks for having me. I'm excited to be here.
Sure. A little bit about Kevin. Kevin is a Florida-based real estate investor, top Apple podcast host, and best-selling author of The Cashflow Investor with over 300 million in real estate transaction under his belt. Based on his decades of experience, Kevin is identified mobile home parks and parking lots as a top real estate investments in the current market. On his podcast, The Real Estate Investing for Cashflow, he shares his 20 plus years of experience guiding millions of listeners on how to find and invest profitably in commercial real estate. So, with that, Kevin, you want to add anything to your background?
No, I think you covered it quite well. Yeah, I've been at this now more than 2 decades. Outside of mobile home parks and parking, I've owned just about every type of real estate asset. I started with single family, owned a few hundred single family homes. I've owned hundreds of multifamily units and other types of commercial, retail, office, industrial, medical office. I don't know if there's anything I haven't yet, but today, for at least for the last 10 years or more, we focus solely on mobile home parks and in parking as well. So, um, again, been at it for quite some time and I've learned a lot along the way.
Awesome. So, how did you get into like real estate and mobile home park space?
No, I was just going to say I got into real estate at a young age. I was introduced to it at 19. I kind of joke and say that it found me. I didn't find it. Ultimately, it was through a local real estate investor who I met through a girl I was dating. So for me, it was why reinvent the wheel? This guy seemed to be very successful at what he was doing. It was something that was really intriguing to me. At that point, I was going to community college. Saw that as an opportunity for me to wrap my arms around and pour my resources and energy into. And so with that, I went to work for, his name was David. I went to work for him for basically free for a year and a half to where I would help him with any part of his business he needed. I would drop off leases. I would go pick up materials at Home Depot. I would return phone calls. I would answer calls for him. I did whatever he needed so that I could learn what he was doing in the industry and what he was doing in his business and how he built his business. So that was really that was the kickoff. I bought my first rental property, single family home, and at the age of 20, and then really just continued to build on the single family stuff for a number of years before really being introduced to commercial real estate. My first commercial endeavor was self-storage. It's a hot topic today. It was a hot topic back then. This is like in 2005, 2006 era. It was just getting legs. That asset class was getting a lot of legs and a lot of attention. And then at that point, I was exposed to other types of commercial real estate. And I realized that at that point, commercial seemed to be better suited for me because I could scale a lot faster. I could buy bigger scale, bigger deals, and not have to buy $100,000 single family home at a time to build a portfolio. And fast forward to 2011, is again got introduced to mobile, and I was intrigued, just like I typically am with something I don't know too much about. I learned a little bit about it through my conversation with the gentleman, and that set me off on this new path of buying a mobile home park. Again, that was 2011. I studied it. I looked at a lot of deals, bought that first mobile home park in 2012 and fell in love with it. And that kind of brings us up to today. We've been buying mobile home parks for over a decade, seen quite a bit, have learned a lot over that time. Today, our portfolio consists of it's just shy of $300 million of AUM. And it's made up of about 2/3 mobile home parks and then 1/3 parking lots and parking garages. Yeah, it's been a fun ride though.
Yeah, awesome. So there are different commercial real estate asset classes, right? Apartments or office building, retails or other.
Correct.
Unsafe storage. What is the reason behind picking mobile home parks and parking
Yeah,
lots?
it's a great question. It's a great question. I'll speak to mobile home parks. They do have a lot of mobile home parks, and parking has a lot of similarities. But with regards to mobile home parks, it was when I met Randy was his name. He's the guy that kind of turned me on to that asset class. I met him in 2011. And at that point in time, Rama, I was pretty much sold. I'd already owned some multifamily, some smaller 36 unit properties, a 60 unit property, a 72 unit. I was sold on that being the way. I felt like I love residential. It made sense to me. I liked commercial as well, but the multifamily stuff just seemed to make more sense. And it was a more scalable business model for me. And in 2011, I was of the mind that I was going to start focusing solely on that. And I met this guy, Randy, who owned mobile home parks. And I didn't know too much about the asset class. I'd never met anyone that actually owned mobile home parks prior to that. And during this lunch meeting with Randy, he piqued my interest on a number of reasons why he felt, again, his opinion, but he felt mobile home parks were superior in a few different areas. One of the big ones was that the residents own their own home. We're just renting land to them, and they own their own units, meaning that the repairs and maintenance responsibilities for the landlord are significantly less. If the roof leaks, if the AC, the resident's taking care of it. We're not responsible in doing that. So that was very intriguing to me because prior to that, I owned all rentals and I had a big maintenance team and there was a lot of moving parts. The other big part that really piqued my interest was the turnover rate was a lot lower. A lot of these folks lived in their units. It was really no different than a subdivision, like a single family subdivision that we might live in, right? Where we own our home, and we might live there for generations. It might be your grandparents, your parents, and you might live in that same subdivision. That's very similar to that of mobile home parks. We've got residents in our communities that have been there for more than 50 years. And so for me, that was really attractive of having a stickier resident. And I think the last part of that sticky resident was that, unlike in an apartment, when the unit comes vacant, you've got downtime. You've got maybe a month or two of make ready to get it back online and get it occupied again. In a mobile home park, if someone goes to sell their home, typically they put it up for sale, either for sale by owner or maybe they hire a realtor. They continue paying the lot rent. They find a new buyer gets qualified. New buyer takes over their home, but also takes over the responsibility of that underlying lot rent. And so there's never a down period to where that lot rent stops coming in. And so again, just some of the basic reasons that really attracted me to it. And outside of that, I think one of the other big things was that this is different today than what it was back then. But back then, it was almost completely dominated by mom and pop owners and operators. And so lots of small families that built really nice communities, but didn't operate them entirely like a business, like a professional business owner would. They weren't as tight on their expenses. They weren't as tight on keeping the rents up with market trends. They did well. They built something great. They made a lot of money at it, but they didn't keep up with it like a professional operator like you or I might. And so that lent itself some opportunity to get in, buy something that's got a number of levers that we can pull. We can make improvements, put money back into it, but also capitalize on a delta between the value today versus what we could increase it to in a fairly short period of time. And for that reason, like that's really like that. I had a 2-hour lunch meeting with Randy. He's the guy that kind of turned me on to it. And I set off on the journey and I bought that first mobile home park. So it took me a little bit, took me about a year, but I bought that first park and that was the start of it all.
Awesome. What a journey. So when you started, what kind of challenges you faced and what kind of challenges you're facing in the current market?
Yeah, that's a great question. I'll speak specifically to the asset class. In 2011, 2012 era, first and foremost, the banking world was completely different than what it is today. It was a complete mess still from 2008. And in addition to that, mobile home parks weren't a well-known asset class. While there's 50,000 mobile home parks in the country, it still wasn't a very well-known asset class. And so one of the biggest challenges that we faced buying those first, call it probably 10 or 12 parks, maybe even more than that, for a number of years, probably up until 2017 or 18, we experienced a lot of headwinds with trying to find good quality loans. Banks that understood the asset class, it would actually lend on the asset class. And so there was, in the earlier years, we had a number of deals that died. Great deals, great economics, like buying it at a 11 cap or 12 cap, ridiculous in a prime marketplace, and couldn't get a bank to lend on it and had it die because we didn't have 100% cash to take it down, right? Very different today. I think banks have finally opened their eyes to the asset class. There's Fannie Mae, Freddie Mac, the agency lenders. They're very hot and heavy in this asset class, just like multifamily. In fact, it's pretty much the same program that they offer to multifamily investors. There's a litany of CMBS and conduit lenders in the space, and then a lot of national and regional and local banks that now very much understand it and are just trying to throw money at the asset class. Whereas before we had to beg, we'd have to go to 30 or 40 banks to try to find one that would say yes. And if they said yes, it still wasn't very desirable terms. Now we're very much categorized and classified as a different form of multifamily. And so the financing's attractive. There's plenty of banks and lenders to go to. And so that was that was probably one of the biggest things that's changed within the industry from the time we started to where we're at today. And I think last to that would be when we started buying, there was no institutional owners in the space. There was 2 publicly traded companies, but those 2 publicly traded companies, their ownership only made up like 2% of all of the mobile home parks in the country. Now you've got the likes of the Blackstone, you've got Apollo Group, all these different large private equity institutional groups that are pouring billions of dollars into the space. And so it's institutionalized it quite a bit and just really put it on the radar for everybody else to take notice of what a great asset class it is. So that was not the case back when we started buying.
Yeah, awesome. Thank you very much. So from picking markets or approaching tenant relationships and maintaining affordability and also profits, how exactly you're managing that?
As far as the day-to-day operations?
Yes.
Yeah, so we're a vertically integrated property management company, and we've been that way for many years. Unlike the multifamily space, there's not nearly as many third-party management companies, so we don't There's a few that have a national reach, but not nearly. It's a fraction of what you might find in multifamily. Multifamily, you can go to any major market, go to Dallas, go to Houston, go to Tampa, go to Orlando, and there's probably no less than a dozen, probably way more than that, property management companies that specialize in multifamily. And that is not the case in mobile home parks. And so we learned a long time ago that first and foremost, someone's ever going to care for your asset as much as you. And then second to that, there wasn't enough options as far as outsourcing the management. And so we were forced to build in-house. And so we have an entirely vertically integrated property management sector of our business. We manage every aspect of our deal from acquisition all the way through disposition and everything in between, which allows us a lot of benefits. It's not a very profitable side of our business. In fact, for us, it's really a break even. We're happy if we break even, but there's not a lot of profit money in property management in general. It's a very thin margin business. And so for us, we want to make sure that we've got our finger on the pulse of what's going on. If we see that there's something going wrong, we can make that change immediately. It doesn't have to go up a corporate ladder through a third party vendor. We're accountable for everything that happens, and it rises to the top fairly quickly. For that reason, we've kept it in house and have no desire, no plans whatsoever to outsource it anytime soon.
So at what point in time you guys went for vertical integration?
So we started buying again back in 2012, and it was just myself, and I had two partners at that time. Today it's just myself and one other partner, but it was really the three of us, and we managed everything, every aspect of the business. We wore all the hats for about 3 years, and we got to a scale where, or we got to a pivotal moment where we looked at ourselves. We're like, look, we're really good at bringing capital in. We're really good at finding great opportunities at great prices, but what we're not great at and what is not fun is obviously the operations, right? It's like the unsexy part of the business. And at that point, we were managing everything ourselves, and we were running around like idiots trying to manage everything. And we were at this threshold as well. Like we didn't have any more time today. We need to start hiring people in house, which we didn't feel we had the money for. We had scale, but not enough scale to really bring it back in house. We'd have had to basically inject a few $100,000 at that point to bring it back in house, and it would be a lost leader for a period of time. And we felt that we didn't want to go that path. We wanted to see if we could outsource it. We went on this journey where we outsourced it to two of the largest property management companies in the country. And it was a failed experiment. Within a year, we handed them, I believe we handed them 12 properties when we brought them on board, and we split the 12 properties between the two different groups to find out who was better than the next, right? Who was the best of the two. And they both sucked. It was a horrible experience. But during that period of us bringing them on board and offloading our property management, we also bought another 7 properties because I was like, look, we're free. We can go. Let's run. Let's buy more properties. And so we handed them 12 stabilized properties that were already turned around. We already done the hard work on them. And then we bought 7 value-add properties that needed to have the business plan executed. Within 13 months, we brought it all back in-house because, again, within 6 months, we realized it was an absolute mistake. We should have just built it in-house at that point and sucked it up. And so we went 6 months into that process. We started secretly building out a property management company, building SOPs, bringing team members in, and trying to secretly build out this infrastructure so that we could bring it back. And it took us about 6 months to really build it and feel comfortable with bringing it back in. But when we brought everything back in from that third-party management company, everything was a turnaround again. Everything had issues again, even the stuff that we handed them that was stable. And so for that reason, and this is back in, I believe this is back in like 2017 era, 2016, 17. We brought it back in. And from that point forward, we've had it in-house and just have never even considered. It's never even been a topic of conversation to ever outsource it again. And there was a period of about 1.5 years, Rama, that we had to feed that machine. We had to feed that beast. We had to pay in money because it wasn't profitable. And it took us to get to about 2,000 lots to where we found a break-even point. And today we've got about 3,400 lots. We've ebbed and flowed with the size of our group, but we found that 2,000 lots is about the break-even point where we can comfortably be a net zero, not be losing money at the property management, but also still have all the controls and mechanisms in place. And we get to drive the ship and not rely upon anyone else.
Yeah, absolutely. So definitely it will give you a lot of control.
Yeah.
And even like in multifamily space also now, like most of the operators moving towards that particular integration to get that control.
It's just hard to find the point in time where you had enough scale to do it. Like that's the challenging point is getting large enough to where you can actually hire the team and the talent and afford the team and talent necessary, because operations is no joke. It takes a very unique person that enjoys that side of the business. And then you got to find a person that enjoys it, but also does it incredibly well. And that's hard to find. It really is. And you got to pay for it. You got to pay for quality, and you got to be of a certain scale in order to have enough revenue, generate enough revenue in order to actually pay for that quality and build out that team. So there's always this pivotal moment of, I wish we could bring it back in house, but we can't afford it. But you have to ask yourself the question, can we afford not to at that point? And do we just need to look at it as an investment, put forth the capital necessary, inject the capital, build out the company, know it's not going to be profitable for a period of time? Just like any new business, right? Like, think about like starting any business from scratch. It's not going to be profitable more than likely for the first couple of years. You got to inject capital in before you start getting it back, getting in return. But it's a tough moment for, I think, for all of us investors, right? Whether you're multifamily or mobile home parks, it doesn't really matter, making that pivotal change.
Yeah, and also building quality team also challenging, right? So that is one other important factor. Yeah.
Yeah.
Yeah. Cool. What are the ways like on market, off market? How exactly source the deals?
Sourcing them. Yeah. So I would say for a very long time, up until about a year and a half ago, about 90% of everything we bought was off market direct to owner. And so us really, we had a whole team internally that would literally, that had a database on the various communities, the owner information. We have a CRM built around it, and we continually just stayed in touch with owners, talked to them on a regular basis. And some owners that we just closed a deal a couple months ago, we've been working on it for 8 years with the owner, just staying in contact, basically taking the part of a broker and just simply maintaining that contact internally. And so that was, I would say 90% of what we bought was direct to owner and sourced by us. We still source properties directly ourselves, but I'd say that over the last 2 years or so, it's probably morphed more to 30% through brokers and 70, again, just relationships that we've already had existing. So we just find that we bought a few parks on market that have actually were listed, that were out to the main marketplace. We just found that we've never been the most competitive buyer. If it goes out to a litany of other buyers, there's always going to be someone that typically has lower cost of capital. There's always going to be someone that is always willing to pay a little bit more, whether that's right or wrong. And we've never found ourselves in that competitive environment, especially like in late 2020, 2021, 2022, when rates were incredibly low and everyone was buying everything. I don't know if we won. We always make offers with brokers on listed properties. We always make offers just because I want to let them know that, hey, we're serious. We might not be the highest buyer. We'll get the deal done if we get awarded the deal. But I don't know if we actually, outside maybe one property that we actually won, that we made it to final investment, actually got awarded the deal if it was listed. I don't know if that's right or wrong. Maybe we missed some opportunity, but we're pretty conservative. We don't step outside of our comfort zone as it relates to just getting out in front of our skis, or, hey, let's just pay a little bit more because it's a great asset, it's a great market, and we'll make it up in the long run. We try to steer clear of that mentality and just stay very disciplined. And for that reason, we probably haven't bought as much as maybe some of our competition, but also it's allowed us to sleep very well at night. We have no floating rate debt. We have no issues. We have low leverage on all of our properties, and we've never stopped distributions. We continually pay our investors. And so while we might not have scaled like crazy like everyone else, our portfolio is solid. It's in great shape, and there's no risk of anything with inside it right now. And now that's, interestingly enough, that put us in a really good position the last 2 years. Like last year was one of our best years. This year will literally, take last year as the best year. So last year we bought about $100 million worth of properties. This year we'll end up a little over $100 million, about $105 million. And a lot of our competition isn't buying right now, or is not able to buy. They don't have the capital, or maybe they're, so focused on their current operations and managing some damage control, right? Whether it's debt maturities or floating rate debt, or maybe looming foreclosures, or the business plan hasn't worked out quite as they projected it, right? They're not getting the rents they wanted, or they've had to decrease rents, offer concessions, like all these things. And we haven't had to deal with that. Now, but I think that's because we were so conservative and disciplined during that period.
Yeah, definitely. That discipline will definitely help in long term, right? So
Mhm.
awesome. So you guys went to full cycle in multiple deals. So what are some lessons learned from it?
Yeah, that's a great question. We've been full cycle on 15 deals so far. And we made a ton of, most of those deals, we absolutely killed it. We made great returns for our investors. A couple of those deals, I don't even like to post the IRRs because it was like 100, near 100% like IRR, and a 3 to 4 year span of time. But with all that being said, there's a lot of properties that we've sold that I look back, I'm like, what? Why do we sell that? It was in such a great market. Like, they're not making more mobile home parks. And it every day becomes more and more difficult to find a mobile home park that's got good bones to it. It's in a good market that has a high demand for affordable housing. They're out there, but there's more competition, no new supply. And so you got this imbalance, and we have to fight harder to find them. And so I think the biggest mistake or the lesson learned is regret and just really thinking about the long-term strategy and the viability of the asset that we're in. And that anytime I sell something, I'm going to have to work even harder to buy something new that I don't know as well. And it might not be as good of a market, right? And the things you own better than anyone else. And so we've really morphed our business plan to, while we might still sell assets, it's more of a buy the ones that we absolutely know that we'd like to hold for a long term. And that could change down the road, but really subscribe wholly to the basically buy and refinance, cash out, refinance, hold strategy. And you can cash out, refinance, tax free, keep rolling that down the road instead of every time you sell, you might get a big hit. But guess what? It also happens. You have tax consequences, fairly significant tax consequences. And then on top of that, you got to go find something else to put the money into. Right. And so I would say that's the regret is the lesson, is really focusing on the assets that are great. Maybe you can peel off the ones that you just don't see a long-term viability in. You've done well with them, but maybe they're not in a market you want to grow a footprint in, or maybe they're not large enough, or whatever, the quality of tenant. But if you've got ones that they're just primo, they print cash, they do incredibly well, but it's in a market that's got limited supply, don't sell it. Just do cash out refinances. Continue executing the business plan. They're going to continue to grow in value over time. And you can keep tapping into that sweat equity that you're building over time. And you don't have to sell it to do it. And you also don't have to worry about the tax consequences today. And you can leverage a 1031 strategy down the road if you do choose to sell. But I don't want to sell anymore. I'm sick of selling properties because, again, it's more and more challenging to find good ones.
Yeah, that's a very good points. Yeah, thank you. So what's your plans for next 2 to 3 years?
Yeah, it's a great question. We had a great, this year's going to wrap up to be a great year. We've already got a number of deals in the pipeline that we'll roll into 2025 with. And we've got a lot of goals, but we've got a number of acquisition goals that are really built around AUM. So we'll end the year at about 300, or just over 300 million of AUM. And we'd like to be at 750 million of AUM by the end of 2027. So I think our target for this coming year is 125 million of AUM, and then basically tiering it up from there over the next 3 years. We've got a great capital sheet. We got great investors in place. We got a great team on the investor relations side. So we've really honed in on our skills and what we're really good at. And we built great team members around it. We've got great investors that have been with us for the ride now for a number of years. And on the flip side of that, our acquisitions team and our operations team, like, they're just kick ass. It's like a night and day difference today of what it looked like maybe even 5 or 6 years ago. Like, we've just got folks that are really talented that can allow us, if we find the deals and we have the money, we've got the team that can actually operate it. So we want to keep on running. We want to keep buying, because again, for us, these are irreplaceable assets. They're literally not making more mobile home parks. They're not making more parking lots. They're not building either one of those anymore. And so if we can find them in great locations and great markets at a great price, then we're going to buy them. So
Awesome. So any personal habits that are helping you to be successful?
yeah, for me, I try to keep things simple. Just exercise on a regular basis, eating right and exercise. That helps with mental clarity. That helps with energy levels. I've got young kids too, so I gotta keep my energy level up for work, then also for family. But just really keeping it simple. What you put in your body ultimately is going to equate to the energy level you have, the mental clarity you have, how you feel at the beginning of the day, how you feel at the end of the day, how you treat others around you, how you handle stress, anxiety, all that. And so for me, starting with that good foundation really allows everything else in my life to really not always work smoothly, but it just seems to work well. And that's the basis. That's the foundation of it all, is really health, fitness, and what you eat.
Awesome. So any books that impacted you?
Yeah, there's a ton. As you can see behind me, I got this is one of 3 bookshelves. One that I probably read every year and I hand out a lot of as gifts to other people. I'm all about charitable endeavors and give it back and trying to improve the lives of others. And there's really 2, actually. One's a newer one, but one I've probably read 7 or 8 years ago and continually read every year is The Go Give. That's a great one. And then the other one recently we read in the last year, and we're actually incorporating in our business, that has really changed how we look at our employees and how we look at not just the employees, but also their families and their internal, what do they want to accomplish in their life outside of making money, outside of getting, salary increases every year. Like, what are their goals and visions and dreams for their family? And how can we help them accomplish that? It's called The Dream Manager. So it's a great book, great read. Both of those books are short reads too. So you can literally knock them out in, a couple hours probably, but those were both incredibly impactful, both personal and professionally.
Awesome. So how can listeners can connect with you, Kevin?
Yeah. So if you want to learn what we're doing at my company, Sunrise Capital Investors, you can go over to investwithsunrise.com, learn a lot about what we got going on there and see the different offerings that we have. On a personal level, kevinbupp.com is my personal website. I also host my real estate investing for Cashflow podcast there. I've been doing it for over 10 years now. And then lastly, I spend a lot of time on LinkedIn, Facebook, and Instagram. My last name's fairly unique. So if you just type in Kevin Bupp, I should be the first result that comes up. I don't think there's any other Kevin Bupps that are in the real estate world.
Awesome. And thank you very much, Kevin. Thank you.
Rama, thanks for having me. It's been a lot of fun.
Sure.